Most people assume that what happens in Tokyo has very little to do with their monthly mortgage payment in Texas, their car loan in Ohio, or the interest rate on a credit card in Florida. But the reality is, the world's financial markets are more connected than ever, and one decision made by some of Japan's largest investors could quietly influence borrowing costs for millions of Americans. If you're a homeowner, planning to buy a house, carrying debt, or thinking seriously about retirement, this is a story worth paying attention to, not because it's a reason to panic, but because it offers a glimpse into how global capital flows can shape everyday finances here. In the United States, recently, Japanese investors reduced their holdings of U.S. government-related bonds by roughly $30 billion during the first quarter of 2026. On the surface, that might sound like just another headline from the financial pages. After all, governments and institutions buy and sell bonds all the time. But what caught the attention of economists wasn't simply the amount. It was the direction of the trend and the reasons behind it. Once you see the numbers in context, you'll understand why this matters more than most people realize. Before we dive into what happened, let's zoom out for a moment. For decades, the United States has relied on investors from around the world to help finance its debt. Every time the U.S. government spends more than it collects in taxes, it issues Treasury securities to raise money. Those treasuries are purchased by pension funds, insurance companies, banks, governments, and investors from around the globe. One of the biggest buyers has consistently been Japan. For years, Japanese institutions found U.S. government bonds especially attractive. The reason was surprisingly simple. Interest rates in Japan remained extremely low for a very long time. In some cases, they were even below zero. That meant investors searching for stable returns often looked overseas, and U.S. Treasuries offered a combination of safety, liquidity, and higher yields. Imagine you're managing billions of dollars for a Japanese pension fund. If government bonds at home pay almost nothing, but U.S. Treasuries offer meaningfully higher returns, the decision is fairly straightforward. Even after accounting for currency risks, investing in American debt could make financial sense. But over the past couple of years, something important has started to change. Japan's own interest rates have begun to rise as the country's central bank gradually moves away from years of ultra-loose monetary policy. Yields on Japanese government bonds have increased to levels not seen in decades. That means investors who once had to search abroad for returns are beginning to find more attractive opportunities at home. And that's where the story really begins. According to the figures discussed in the recent reporting, Japanese investors reduced their holdings of U.S. government-related bonds by nearly $30 billion during the first quarter of the year. While that represents only a small portion of Japan's overall holdings, it marked the largest quarterly reduction in several years and suggested that some large institutions were rebalancing their portfolios. Now, it's important to keep this in perspective. Japan still remains one of the largest foreign holders of U.S. Treasuries. Selling a portion of those holdings doesn't automatically signal a crisis or a loss of confidence in the United States. Financial institutions constantly adjust portfolios based on changing economic conditions, interest rates, and investment opportunities. That's an important distinction because headlines often leave out the nuance. This isn't necessarily a story about investors abandoning America, it's also a story about Japan changing. When conditions improve at home, capital naturally has a reason to stay home. Think of it like owning two rental properties. If one property suddenly starts generating much better returns while carrying less risk, you might choose to invest more money there. It doesn't necessarily mean the other property has become bad. It simply means your priorities have shifted. The same principle applies here. As Japanese government bonds become more competitive, some investors no longer need to take on currency risk by purchasing assets overseas. That shift changes the balance of demand in one of the world's largest financial markets, and this is where many people assume the story ends. It doesn't, because when one of the world's biggest buyers purchases fewer U.S. government bonds or sell some of the ones it already owns. The question naturally becomes, who steps in to replace that demand? The answer matters because bond markets influence far more than government financing. They help shape mortgage rates, auto loans, business borrowing costs, and even the interest you may earn on savings accounts, but the connection isn't always obvious. When most people hear the phrase bond market, their eyes tend to glaze over. It sounds like something that only matters to Wall Street traders or central bankers. But in reality, the bond market quietly influences some of the biggest financial decisions in your life. Whether you're buying your first home, refinancing a mortgage, financing a new car, or simply wondering why borrowing still feels expensive even when the Federal Reserve hints at lower interest rates, the bond market is often part of the answer. So let's simplify it. Imagine the US government needs to borrow money. Instead of walking into a bank, it issues Treasury securities. Investors, from pension funds and insurance companies, foreign governments and individual savers, buy those securities because they're generally considered among the safest investments in the world. But just like any other market, price depends on supply and demand. When demand for Treasury bonds is strong, investors are willing to accept lower returns because they're competing to own them. When demand weakens, the government has to offer higher yields to attract buyers. That's the key relationship to remember. Lower demand generally means higher yields. Higher yields may eventually influence borrowing costs throughout the economy. Now, this doesn't mean every mortgage rate immediately jumps the moment one country sells bonds. Financial markets are much more complex than that. Mortgage rates are influenced by inflation, Federal Reserve policy, economic growth, banking conditions, and investor expectations. But Treasury yields are one of the most important benchmarks in that equation. Think of them as the foundation of the financial system. If that foundation shifts, many other interest rates often adjust over time. This is why economists paid attention when Japanese investors began reducing their holdings. Again, the amount sold, around $30 billion, is relatively small compared to Japan's overall position. Japan still remains one of the largest foreign holders of U.S. Treasuries. The concern isn't that 1/4 of selling suddenly changes everything. It's whether this marks the beginning of a longer-term trend. And this is where the conversation becomes much more interesting. Let's imagine you're running a large pension fund in Japan. For nearly 2 decades, domestic government bonds offered very little return. To earn more income, you invested abroad, including in U.S. Treasuries. Now fast forward to today. Japanese bond yields are improving. Suddenly, you can earn a more competitive return at home without taking on exchange rate risk. From a business perspective, that's a perfectly rational decision. You aren't necessarily betting against America. You're simply finding better opportunities in your own backyard. That's an important difference because headlines often make it sound like countries are dumping U.S. debt out of fear. Sometimes that's true, but often it's simply portfolio management. And understanding that difference helps investors avoid making emotional decisions based on dramatic headlines. Now here's where most people get caught. They assume that if Japan buys fewer treasuries, someone else will automatically replace every dollar without any consequences. Maybe not. Markets usually adjust. Domestic investors can buy more. Banks can increase their holdings. Insurance companies may find higher treasury yields attractive. Other countries may decide U.S. government debt still offers one of the best combinations of safety and return. Capital doesn't disappear. It moves. The real question is price. If new buyers require higher yields before they're willing to invest, then borrowing becomes more expensive, not just for governments, but potentially for households and businesses as well. Let's make that practical. Imagine 2 families purchasing the exact same $450,000 home. The first family locks in a mortgage at 5%. The second family buys when mortgage rates have moved to 6.5%. Even though the home price hasn't changed, the second family could end up paying hundreds of dollars more each month and tens of thousands of dollars more over the life of the loan. That's why even relatively small movements in long-term interest rates matter. The same principle applies to businesses. When borrowing becomes more expensive, companies may delay expansion, reduce hiring, or postpone major investments. Governments also feel the pressure. As older debt matures, refinancing at higher interest rates increases interest expenses. That means a larger share of future government budgets may go toward servicing debt instead of funding other priorities. Again, none of this suggests an immediate crisis. It's a reminder that global financial markets operate through gradual shifts, not overnight transformations. And here's the part almost no one talks about. Professional investors aren't watching one quarterly sale, they're watching the pattern. One quarter can reflect routine portfolio adjustments. 2 or 3 quarters may still be noise. But if major foreign investors consistently reduce their exposure over several years, while domestic alternatives become increasingly attractive, that would represent a much more meaningful structural shift, and that's exactly what economists will be monitoring in the months ahead. Because in financial markets, trends usually matter far more than headlines. The difference between households that struggle during economic shifts and those that come through them stronger usually isn't luck. It isn't having inside information, and it isn't predicting the future perfectly. More often than not, it comes down to preparation. There are 2 paths that begin to emerge whenever the financial landscape starts changing. The first path is reactive. These households wait until higher interest rates have already affected their monthly budget. They refinance only after borrowing becomes expensive. They carry high-interest credit card balances month after month, assuming rates will eventually come back down. They make financial decisions based on headlines, emotions, or short-term market swings. The second path is strategic. These households understand that while they can't control the economy, they can control how prepared they are for it. They build emergency savings before they need them. They reduce expensive debt whenever possible. They review their investments regularly instead of reacting to every news cycle. Most importantly, they understand that economic shifts create both risks and opportunities. The difference may seem small today. 5 years from now, it can completely change a family's financial future. Let's make this personal. If you're in your early 30s and saving for your first home, this environment may require a different strategy than it would have just a few years ago. Instead of focusing only on the purchase price, it's worth paying close attention to the monthly payment. Even a modest increase in mortgage rates can significantly affect affordability. In some cases, waiting a little longer to improve your credit score or increase your down payment may save more money than rushing into a purchase. If you're already a homeowner with a fixed-rate mortgage, your situation may actually be more stable than you realize. While new buyers may face higher borrowing costs if long-term interest rates remain elevated, homeowners who locked in lower fixed rates are largely insulated from future rate increases on their existing mortgage. That doesn't eliminate other financial challenges, but it does provide a level of predictability that many households value. Now consider someone approaching retirement. Many retirees focus primarily on stock market performance, but interest rates matter just as much. Higher Treasury yields can increase the income available from traditionally safer investments, which may become attractive for investors seeking stability. At the same time, inflation remains an important consideration because rising prices can gradually reduce purchasing power over a retirement that may last 20 or 30 years. The goal isn't simply to earn the highest possible return. It's to balance growth, income, and risk in a way that supports long-term financial security. And if you're carrying high-interest credit card debt, this may be the most important takeaway in the entire video. Credit card interest rates often remain significantly higher than mortgage rates or auto loans. Even if broader interest rates eventually decline, revolving debt can continue to compound quickly. Every dollar used to reduce high-interest debt creates a guaranteed improvement in your financial position by lowering future interest costs. That's not speculation. That's simple math. Now let's talk about something that often gets overlooked during discussions like this. Cash flow. Many people focus entirely on investment returns while ignoring the health of their monthly budgets. But during periods of economic uncertainty, positive cash flow becomes one of the most valuable financial assets a household can have. When your income consistently exceeds your expenses, you gain flexibility. You can invest when opportunities arise. You can handle unexpected repairs without relying on expensive debt. You can weather periods of market volatility without being forced to sell investments at the wrong time. That flexibility is incredibly valuable. So what can you actually do this week? Start by reviewing every loan you currently have. Know the interest rate on your mortgage, your auto loan, your student loans, and especially your credit cards. Many people know their monthly payment but have no idea what interest rate they're actually paying. Next, look at your emergency fund. Financial planners often suggest keeping several months of essential living expenses in readily accessible savings. The exact amount depends on your personal circumstances, but having a financial cushion can reduce the need to rely on high-interest borrowing when unexpected expenses arise. Then review your investment allocation. Ask yourself whether your portfolio still reflects your goals, your time horizon, and your tolerance for risk. Major economic headlines often tempt investors to make emotional decisions, but successful investing is usually built on discipline rather than prediction. If you're planning to buy a home within the next couple of years, spend some time calculating how different mortgage rates would affect your monthly payment. Even small changes can have a meaningful impact on affordability, and understanding those numbers now can help you make more informed decisions later. Finally, stay informed, but don't confuse information with action. The financial news changes every day. Headlines are designed to capture attention. Your financial plan should be designed to withstand changing headlines. That's an important distinction. As we bring everything together, it's worth remembering what this story is really about. Japan's recent reduction in U.S. government-related bond holdings isn't, by itself, evidence that the global financial system is in crisis. It's one development within a much larger picture of changing interest rates, shifting investment incentives, and evolving economic conditions. The bigger lesson is that global markets are interconnected. A policy decision in Tokyo can influence investment flows. Investment flows can influence bond markets. Bond markets can affect borrowing costs. And borrowing costs can shape household budgets across America. Understanding those connections doesn't mean trying to predict every market move. It means making thoughtful financial decisions based on long-term principles rather than short-term emotions. History has shown that the households that build lasting wealth aren't usually the ones that perfectly time every economic cycle. They're the ones that save consistently, invest patiently, manage debt wisely, and adapt when conditions change. Economic trends will continue to evolve. Interest rates will rise and fall. Markets will experience periods of optimism and uncertainty. But financial resilience isn't built during moments of stability. It's built through consistent decisions made long before the next headline appears. So here's a question I'd love to hear your thoughts on. Do you think Japan's changing investment strategy is simply a normal adjustment to higher domestic interest rates, or could it signal the beginning of a larger shift in the global bond market? Share your perspective in the comments below. Thoughtful discussions often help all of us better understand these complex topics, and if you enjoy clear, data-driven explanations that cut through the noise without the hype, consider subscribing. Every week, we'll break down the economic stories that matter most, not to create fear, but to help you make smarter financial decisions with confidence. Thanks for watching, and I'll see you in the next video.